Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. P.T. Barnum is credited with the quote, "There's a sucker born every minute." And this is what Robinhood said in their Super Bowl commercial.
You don't need to become an investor. You were born one. Robinhood.
Now, I don't personally think that all Robinhood users are suckers. However, after doing the research required to produce this episode, I do believe that Robinhood's business depends on novice investors behaving in a way that's detrimental to their financial future. I'll explain why, but first let me begin with what inspired this episode. Yesterday, I posted a quote on @CharlieMungerQuotes on Instagram of something Charlie Munger said about Robinhood at the Daily Journal shareholder meeting on February 24th, 2021. Quote, "Robinhood trades are not free. When you pay for order flow, you're probably charging your customers more and pretending to be free. It's a very dishonorable, low-grade way to talk." There were enough comments asking for an explanation about what Charlie meant that I wanted to stop the episode I had been working on and focus on this first. So Robinhood is the leader in commission-free trading. And by making commission-free investing the norm, other brokerages like Charles Schwab, E-Trade, and TD Ameritrade also now offer commission-free trades. But the question you have to ask yourself anytime someone's offering you something for free is, what's in it for them? Let's first begin with what Robinhood says on their website about how they make their money. And this comes from Robinhood.com. Quote, "When you buy or sell stocks, ETFs, and options through your brokerage account, your orders are sent to market makers for execution. To compete with exchanges, market makers offer rebates to brokerages." Now, if you don't understand that, you're not alone. I didn't understand it either. But what they're describing is something called PFOF, Payment for Order Flow. PFOF. This is an example that Fortune.com provided in July 2020 in an article about Robinhood's business model. Quote, "When you buy a share of Tesla on your phone, Robinhood sends that order to a trading giant like Citadel Securities and receives a few pennies in return, the PFOF. Citadel, meanwhile, completes your trade and makes a few pennies itself. Now, these pennies add up. In 2020, Robinhood reportedly made upwards of $682 million from order flow revenue alone. And this represented a 514% increase year to year. There's nothing illegal about making money this way. And some of those firms I mentioned earlier also make revenue from PFOF. The difference is that Robinhood makes the majority of their revenue this way. Now, if you listen to our first episode of Compound Money Quietly, we talk about the Charlie Munger quote, "Show me the incentives and I'll show you the outcome." So the outcome is that Robinhood is making boatloads of money from order flow. How are they incentivizing this behavior? According to an administrative complaint filed by the Commonwealth of Massachusetts to Robinhood Financial LLC, the answer is gamification. This is how they describe it. Quote, "Once individuals become customers, Robinhood relentlessly bombards them with a number of strategies designed to encourage and incentivize continuous and repeated engagement with its application. The use of these strategies is often referred to as gamification. The application of typical elements of game playing to other activities, typically as a marketing technique to boost engagement with a product or service. Robinhood rewards customers with colorful confetti raining down their screens after executing trades on its application." Now, that's just one example, and it's just so obvious what they're trying to do. It's rewarding behavior in a very tactical way. But the problem is the behavior they're rewarding, which is frequent buying and selling, is proven to be very, very bad if you're looking to build wealth over the course of your life. Academic research shows that individual investors do worse the more that they trade. In one of these academic journal articles that was published in 2001, and it has over close to 4,000 citations via Google Scholar, it notes that, quote, "Overconfidence can explain high trading levels and the resulting poor performance of individual investors. Our central message is that trading is hazardous to your wealth." I shared this in a newsletter that went out last week via cmqinvesting.substack.com. You can read the archives for free just by entering your email. And when you sign up, actually, you'll be first to be notified when we have new content like these podcast episodes. But Another one of the points I made in that particular post was using a quote from Christine Benz, who's a director of personal finance for Morningstar. And she has one of my favorite quotes related to the detrimental effects of active trading. And it goes like this: "Your portfolio is like a bar of soap. The more you handle it, the smaller it gets." But what if Robinhood's active investors are the skilled investors who, the more they handle it, the better they do? But the fact is, and we have to look at this as it is Robinhood is marketed towards new investors. And this is what Robinhood's co-founder told Jim Cramer during an appearance on CNBC on December 10th, 2019, right after they had reached 10 million subscribers. "We're proud of the fact that we've enabled so many younger investors and first-time investors to have access to the markets." Now, since this appearance on CNBC, Robinhood has acquired approximately 3 million more subscribers. And common sense tells us that these investors are also new to the game. The clip from Robinhood's Super Bowl commercial makes it crystal clear that this is still their target audience. But these Robinhood users are adults, and they're responsible for their own decisions. And you could argue that these investors would have to learn the hard way that active trading is not a sound way to accumulate wealth, with or without Robinhood. But the issue is that their name is Robinhood. And this brings us full circle. This connotates this character who would take from the rich and give to the poor. But when you're making money, and the majority of your money from PFOF, or payment for order flow, you're taking your customers' money and you're actually charging them more because you're making money for and from, the big guy. And this just seems disingenuous in a way that it wouldn't be if the name wasn't Robinhood. It also wouldn't be so suspect if the description of how they make money wasn't so vague and coded. Remember, this is what it says on Robinhood.com on the section How Robinhood Makes Money. "When you buy or sell stocks, ETFs, and options through your brokerage account, your orders are sent to market makers for execution. To compete with exchanges, market makers offer rebates to brokerages." That's not very it's not very transparent, even if you know what order flow is. There's a lot more we could cover here, but I wanted to stick to what actually you were looking for in understanding that initial quote. But if you'd like to learn more about any of the materials I mentioned, as well as even more than what I mentioned, there will be a post about this episode at cmqinvesting.substack.com. Let's conclude with that Charlie Munger quote and see if we understand it better now. "When you pay for order flow, you're probably charging your customers more and pretending to be free. It's a very dishonorable, low-grade way to talk." Charlie Munger says the best thing a human being can do is to help another human being know more. If this episode helped you know more, then please help someone else do the same and share it with them. My name is Chris Franco. This is Compound Money Quietly, the CMQ Investing Podcast. Tune out the noise. Tune in with us. This is Compound Money Quietly. I'm Chris Franco. Thanks again for listening.